Hello everyone, my name is Crystal Caballero and today I am excited to present my topic on accounting for business combinations under the International Financial Reporting Standard IFRS number 3. Business combinations provide rules for how to handle the accounting for these mergers and acquisitions. So this topic is essential because business mergers and acquisitions happen all the time and companies must follow strict accounting rules to report these transactions accurately. So have you ever wondered how big companies like Amazon, Facebook, or Disney report their acquisitions? The process is more complex than just paying a price. It involves recognizing assets, liabilities, goodwill, and much more. So in this presentation, I will explain what business combinations are, how they are accounted for under IFRS 3, and why this standard is so crucial for financial reporting. So now let's begin by understanding what a business combination is and why companies go through this process. So business combination is when a transaction in which company gains control of another. The aim of IFRS 3 is to make sure that these transactions are recorded properly so the financial condition of both the acquired company and the acquired company is clearly shown. This helps everyone see the true financial position of each company involved in the transaction. So there are actually three types of business combinations. So a business combination takes place when a company called the acquirer takes control of another company known as the acquiree. So the first type of business combination is the mergers. This is when two separate companies join together to become one new company, creating a single legal entity. So an example of this is when Disney and Pixar joined forces and became one company. Number 2 is acquisitions. This happens when one business buys out another business to gain control over it. So think of how Facebook bought Instagram to become its owner and have control over its operations. Lastly is the takeovers. This happens when a company takes control of another company without a friendly agreement or mutual understanding. So this type of acquisition is often referred to as hostile as it occurs without the approval of the company's management or board. IFRS 3 is used for these transactions, however, it does not cover joint ventures or when buying assets that aren't seen as a business. Now that we understand the importance of business combinations, let's take a closer look at how companies account for them using the acquisition method. Now, the acquisition method is the only method allowed by IFRS 3 for handling the finances when businesses merge or one buys another. This process involves 4 important steps. Step 1 is identifying the acquirer. The acquirer is the business that gains control over another business. Control is defined by owning over half of voting shares or the ability to decide on key financial and management policies. Sometimes, contracts can give this power too. Now, with the acquirer identified, the next step is to determine the acquisition date. This plays a critical role in recognizing the transaction in financial statements, as this is often the day when the deal is closed and official ownership changes from one business to another. Next step is recognizing and measuring assets and liabilities. On the acquisition date, the acquirer needs to identify and measure 3 things. First is identifiable assets. So this includes anything the acquired business owns, like cash, inventory, buildings, or patents. Next is the liabilities. So these are the debts and obligations of the acquired business. Lastly is the fair value of consideration transferred. This actually refers to the value of what the acquirer gives in return, such as money, shares, or other assets. Everything must be evaluated at fair value to ensure the financial records show the true worth at the time of the acquisition. Last step is recognizing goodwill or a bargain purchase gain. So goodwill is when the price the acquirer pays is higher than the fair value of the acquired company's net assets. So the extra amount will be recorded as goodwill. Now this reflects intangible benefits such as brand reputation and loyal customers. Next is the bargain purchase gain. So this happens when the purchase price is lower than the fair value of the net assets. The acquirer notes the difference as a gain in their financial reports. Now, this situation is not common and often happens when the seller must urgently sell. So, this streamlined process is structured to ensure accuracy and transparency in financial reporting for business combinations. So now let us quickly go through in recognizing and measuring considerations. So the assets and liabilities that will be recorded at fair value are cash and cash equivalents, intangible assets such as trademarks and patents, property, plant, and equipment, and lastly liabilities such as debts and legal obligations. So now the acquiring pays through these things. It's either number one, cash payments, or issuance of shares, or contingent consideration where future payments will be based on performance. So once we have recorded all the assets and liabilities, we need to determine whether the purchase price exceeds or falls short of the net assets. So now this brings us to the concept of goodwill and bargain purchase. So like I've said earlier, goodwill represents future economic benefits such as the brand reputation and customer loyalty. This will be calculated where purchase price will be deducted by fair value. So for example, the purchase price of a company is $50 million. Now the net assets acquired is $40 million. So if you minus 50 from 40, the goodwill that will be recorded is $10 million. Bargain purchase happens when the acquisition price is actually less than the net assets acquired. Then this will be recognized as a gain in profit and loss. Now that we have understood goodwill and bargain purchase, let us now go to non-controlling interest treatment or NCI treatment. A non-controlling interest is the part of the subsidiary's ownership not owned by the main company. So under IFRS 3, there are actually two ways to measure NCI. Number one is fair value method. This measures NCI by looking at the fair value of the subsidiary's total equity. And the second one is proportionate share of net assets. This approach measures NCI as a percentage of the subsidiary's identified net assets. The choice of NCI measurement method is crucial because it affects the financial reports, especially in consolidated financial statements. This choice can influence how investors and stakeholders view the company's financial position since these reports combine the financial data of the parent company and its subsidiaries, giving a comprehensive picture of the company's operation. Understanding these methods is important for anyone involved in financial reporting and analysis. Now let's go on to our consolidation and financial reporting. So after a business combination, the company that takes over must create consolidated financial statements as per IFRS 10, which is the consolidated financial statements. This means they incorporate all financial details of the acquired company into their own reports. So there are two important points in consolidating financial statements. Number one is removing internal transactions. Financial transactions like sales or loans between the main company and the smaller company it owns must be removed. This prevents counting them twice in the financial statements, which can blur the real financial picture. Number 2 is the goodwill impairment testing. Goodwill is a unique asset that represents the extra value paid during the acquisition above the normal value of the company. Unlike other assets, goodwill is not reduced in value over time through amortization. However, it needs an annual test to see if its value has decreased. If it's found that the value has dropped, it needs to be adjusted in the financial records. Proper consolidation is crucial because it ensures financial statements accurately reflect the financial health of the entire group of companies, that will provide a clear and honest view for investors, regulators, and other stakeholders. Now, this accuracy in reporting helps maintain trust and supports informed decision making. So now let us give a real world example. For example, is when the Amazon acquiring Whole Foods in the year of 2017. So the buying price of the Whole Foods is 13.7 billion. The fair value of net assets was $4.6 billion. Now the goodwill that was recorded was $9 billion. This goodwill amount includes things like the strong reputation of the Whole Foods brand, the loyalty of its customers, and the potential benefits from combining the operations of both companies. This graph shows how companies calculate goodwill and why it is important when one company buys another. It highlights the extra value not seen just in the physical and financial assets, but in the intangible aspects that can boost a company's success after an acquisition. So while IFRS 3 provided a clear framework for business combinations, applying this standard comes with its challenges. Now let's take a look at some of the key difficulties accountants face. So there are actually 3 that are listed here, and number 1 is the fair value measurement problems. This occurs when assessing the fair value of items like intangible assets, contingent liabilities, and non-monetary assets that can be both tricky and open to interpretation. Next is the goodwill impairment testing. Each year, businesses have to carry out tests to check if goodwill has been impaired. This requires a lot of careful decision making, and mistakes can lead to inaccurate financial reporting. Number 3 is complexity in using IFRS 3. So following the rules of IFRS 3 requires special accounting skills. So this can make it expensive and very time-consuming for companies to ensure that they are in compliance. So in summary, IFRS 3 ensures transparency in how companies account for business combinations. By applying the acquisition method, firms can fairly measure assets, liabilities, and goodwill in financial statements. However, challenges such as goodwill impairment and fair value estimations require very careful judgment. So by fully understanding IFRS 3, businesses can make smarter financial choices and adhere to international accounting standards properly. This helps in maintaining transparency and consistency in financial reporting, which makes it easier for everyone to understand the company's financial health. So these are the references that I have used. Thank you for your time. I hope this presentation helped clarify the principles of IFRS 3 and its importance in financial reporting. Bye!